Hi everyone. So in this video, I want to explain an example that shows how different transactions affect financial statements such as balance sheet, income statement, and cash flow statement. So in this example, first you are given the balance sheet of the company at time 0. So as you can see in the assets section, we have cash holdings, $168. We have other current assets which include inventory for $493, and then we have total current assets, which is the sum of cash and other current assets. And then we have non-current assets, that these are long-term assets such as property, plant, and equipment. The amount of these assets in the company is $908. So total assets is the sum of short-term assets and long-term assets. And then we have the section of liabilities. Liabilities can be divided to two sections, debt and non-debt liabilities. As I mentioned before, non-debt liabilities are liabilities that are not interest-bearing. And total liabilities is the sum of debt plus non-debt liabilities. Then we have net assets. Net assets is the amount of total assets minus total liabilities. So in fact, net assets is the same as shareholders' equity, because shareholders' equity is the residual claim. It's the amount of money that stays in the firm after paying back all the debt. Shareholders' equity is equal to total assets minus total liabilities. So then we have income statement that we want to create, and then we have cash flow statement. Okay, so let's go to the transactions that we have here. We have 10 transactions. For each of them, we want to see how each of these transactions affect each of the financial statements that we have. So the first transaction is selling furniture for $2,480 cash. So first of all, this shows us that the company's cash is going to increase by $2,487. So let's consider this change in cash, $2,487. Okay, and then because this is a selling product or finished goods to consumers or customers, this is the revenue of a company. So we should go to income statement and we should add this in the section for revenue, right? $2,487. Okay, so this is the first transaction. And this transaction is related to operations. So we should go to cash flow statements to the section that is related to operating activities, and we should add this to the section that is revenue or receipts from customers, right? So I add this to this section too, $2,487. Okay, so we updated all three financial statements that we have. Let's go to the second transaction. The second transaction is restocking furniture for $1,576. This offsets cost of goods sold. So in other words, after the company sells its products and the inventory goes down, the inventory of finished goods goes down, the company will goes and pay for $1,576 and increases the inventory of furniture. Okay, so first of all, this is the cost of goods sold. This is a cost of goods that were the cost of production for the goods that were sold by the company. So first of all, we should consider this in the cost of goods sold in the income statement. So this is a production cost for the goods in the company. Okay, after considering this in the income statement, the section of gross profits, we know that it is equal to revenue minus cost of goods sold. So we updated income statement for this transaction. Now, let's go to the balance sheet. When we pay for restocking furniture, this is a cash outflow from the company. So, in this section, for the cash holding in the balance sheet, we should subtract this amount. We should subtract $1,576. Okay, another thing that happens here is that because the company restock furniture, the level of current assets, which is here inventory of the company, doesn't change. In other words, whatever inventory the company had and used it for production, it went and restocked it. So the other current assets that includes inventory doesn't change. Okay, so I add this here too. And okay, now this transaction again is related to operational activities in the company. So let's go to statement of cash flows. And this cash flow is an cash outflow. In other words, the company pays this amount of money to restock furnitures, right? So this is a payment to suppliers, right? So we should consider it here. And the amount is $1,576. Okay, so again, we updated all three financial statements for this transaction. Okay, let's go to the third transaction that we have. The third transaction is other cash operating costs. So the first thing that comes to our mind is that this is related to the production of the company. So this should affect income statement. You go to row 20, other cash operating costs, and you consider this amount of cost for wages, rent, and etc. This is a cost that is not directly related to production, but it is necessary for the production to happen, right? We should pay rent, we should pay wages, and etc. So we consider it in income statement. So now we can find EBITDA, or earnings before interest, tax, depreciation, and amortization. Okay, EBITDA is equal to gross profit minus cost of other operating costs. Okay, so we updated income statement. Now let's go to the balance sheet. Because it is mentioned that we are paying in cash, the operating costs are paid in cash, so it will affect our cash holdings, and it is going to be a cash outflow because you pay wages and rent to your employees or your landlord, right? So $598 should be subtracted from cash holdings. And so now we should add this, consider the effect of this transaction on a statement of cash flows or cash flow statement. Again, this cash flow is related to operation of the company. So we should consider it in that section. And how much did we pay? $598. So let's go to cash flow statement, the section that is for operating activities, to go to the section that is related to payments to suppliers and employees, right? You are paying rent, you are paying wages to your employees. This is a cost for your production, so you should consider it in this section. So let's add it here. Payments to suppliers and employees for the amount of $598. Okay. Now we should go to the fourth transaction. The fourth transaction is depreciation by $80. First of all, depreciation is considered in income statement. As you can see, after we find EBITDA, we should subtract depreciation and amortization. So consider depreciation, add depreciation in this section. Now you can find EBIT, or earnings before interest and tax. This is equal to EBITDA minus the amount of depreciation. It is important to know that depreciation is not a real cash flow. In other words, the company doesn't pay $80 to anyone or to any entity. This is just the cash flow in order to consider the decrease in the value of assets of the company. Okay, now we updated income statement. We should consider the effect of depreciation on balance sheet. As I told you, the assets on the balance sheet are reported on the basis of net book value. In other words, they are reported in basis of book value minus the depreciation of that asset. So depreciation is $80, and these $80 should go and be subtracted from the value of non-current assets, long-term assets that have depreciation, right? Okay, so just pay attention. This row 6 is total current assets, which is the sum of the cash and other current assets. Okay? And as you know, total assets is equal to the sum of the non-current assets and current assets. Okay. So we updated our balance sheet. Okay, now you should notice that depreciation is not a real cash flow, so we don't make any changes for depreciation in cash flow statement, right? Because depreciation is not a real cash outflow. It's only considered for the decrease in the value of assets over time. Okay, so we updated our balance sheet, we updated our income statement for depreciation, and cash flow statement is not affected by depreciation. Let's go to the next transaction. Next transaction is spending $315 on long-term assets, on property, plant, and equipment, or PP&E. So, first of all, you are paying in cash, so your cash holdings should be affected. So let's subtract this amount from our cash holdings. Okay. And on the other hand, what we are doing, we are increasing the level of our long-term assets by $315. So we should add it to the section of non-current assets or long-term assets. So we added to this section of $315. Okay, we updated our balance sheet for this transaction, for investing in a long-term asset. We subtracted from cash holdings the amount that we paid, and we increased the amount of non-current assets. Okay, does this transaction affect income statement? This transaction does not affect our income statement because this is a capital expenditure and it doesn't show up on income statement. But on cash flow statement, we should go to the section that is related to financing activities and we should consider this transaction, right? Cash flow cash flow from investing activities and we should consider this transaction. So we have capital expenditure. Capital expenditure is the amount of money that the company invests in long-term assets like property, plant, equipment, etc. So here we should consider this amount of $315, right? Okay, so we consider it on cash flow statement. This transaction doesn't show up on income statement and we updated the balance sheet. Next, we go to transaction number 6. In this transaction, we pay taxes of $46. When we pay the taxes, it seems that here it is in cash, right? So we are taxes of $46. First place that paying tax shows up is on income statement. So go to the section that is related to income tax expenses and add this $46. On the balance sheet, this amount should be considered because we are paying it a tax in cash. In this case, we are paying it with cash. So it will affect your cash holdings. And this is a cash flow. This is a real cash flow and it is a cash outflow. So we should consider this on cash flow statement. Go to the section that is related to tax payment and consider this $46. Okay, we updated all 3 statements for this transaction. Let's go to the 7th transaction. 7th transaction is paying interest expense of $13. As you know, the first place that this is the in the first statement that is affected by paying interest is income statement. Go to the section that is related to interest expenses and consider the amount of $13. This is a real cash outflow. So it will affect your cash holdings on the balance sheet. So you should subtract $13 from your cash holdings. At the same time, it will affect cash flow statements. The interest payment of $13 is considered in operating activities section of cash flow statements. Okay, so we updated all 3 financial statements for transaction 7. Now we go to transaction 8. Transaction 8 is about raising capital through debt. So the company issues $306 of debt. That means that the amount of cash holdings in the company increases by this amount. So we should increase the amount of money that now the company has by $306. And this shows that the amount of debt in the company has increased. So on the section of the balance sheet that is related to liabilities, you should go to the section that is debt and you should increase the amount of your debt by $306. Okay, financing capital through debt doesn't affect income statement. Income statement is all about right now is income statement is all about how how much money did you earn and how much you had to spend money to produce finished goods or to provide the services that you could sell to your customers. So income statement is not affected by this transaction. However, this is a real cash flow, and in fact, it is a cash inflow for the company. So on cash flow statement, you should go to the section that is related to financing activities. You see that we have issue of debt here, and you should add the amount of $306. Okay? So we updated cash flow statement. Next, consider transaction 9. In transaction 9, the company pays dividends of $36. This payment of dividend is in the form of cash, so your cash holdings should decrease by $36. So after your cash holding is affected by paying dividends, you should know that the income statement is not affected by paying dividends. This is not related to the current revenue of the company or how much the company had to spend on material and goods related to production in order to make the production happen. But in cash flow statement, because paying dividends is a real cash outflow, you should consider this. So you should pay a dividend of $36. And you should consider it on financing activities. This dividend is paid to shareholders of the company. Okay. The last transaction that we have here is paying $11, spending $11 on share repurchases. Share repurchase means that company pays its stockholders or equity holders and buys back their share. So, because this payment is in cash, it will affect your cash holdings, and your cash holding will decrease by $11. Next thing that happens is that this is share repurchase. Share repurchases do not show up on income statement, but it shows up on cash flow statement. So on cash flow statement, you have a cash outflow of $11. Okay, so we updated all three financial statements for all the transactions that we have in this example. Okay, after updating all three financial statements for the transactions that we have, let's complete the balance sheet, income statement, and cash flow statement. So, we didn't have any transactions related to non-debt liabilities. So non-debt liabilities stays the same. And total liabilities, as we know, is the sum of debt plus non-debt liabilities. As I told you, net assets is equal to total assets minus total liabilities. So net assets becomes $846. As I mentioned earlier, net assets is the same as shareholders' equity. So shareholders' equity is $846 too. So our income statement is most parts are updated. So the only part that we should update is the formula for pre-tax profit. Pre-tax profit is equal to EBIT minus interest expenses. And net profit after tax is equal to pre-tax profit minus income tax expense. So the net profit after tax in this company is $174. Let's go to the cash flow statement. Cash flow from operating activities. You should here pay attention. Which of these cash flows was a cash inflow and which of them was a cash outflow? Those that are cash inflow, they should take a positive sign, and those that are cash outflows, they should take a negative sign. So we can do it in this way. So receipt from customers is a positive cash flow, but payment to suppliers and employees is a cash outflow, and we should consider a negative sign for it. Interest payment is a cash outflow. Tax paid is a cash outflow. So we subtract them. So the cash flow from all operating activities is $254. Cash flow from investing activities, we only have one cash flow. So total cash flow is equal to that. And we should pay attention. This is capital expenditure. So it is a cash outflow and it should be negative. Then we find cash flow from financing activities. Cash flow from financing activities is equal to issue of debt. It is a cash inflow. This money goes to cash holdings of the company. But payment of dividends and share repurchases, both are cash outflows, so we should subtract them. So cash flow from financing activities becomes $259. Now, something that we should pay attention to. What was the cash at the start of the year? Go to the balance sheet, the first balance sheet that you were given. Cash holding was $168. Now, from cash flow statement, you can find change in cash. The change in cash is the sum of all cash flows from operating activities, investing activities, and financing activities. Just sum them up, right? So add this to this one and to this one. So you see the change in cash during this period as a result of those transactions was positive. So the cash that you should have at the end of the period in your balance sheet, it should be the cash that you had in the beginning plus the change in cash holding, which is $366. Now, if you go up to your new balance sheet, the amount of cash holding should be this value. As you can see, the amount of cash holding is exactly $366. Another point that I want to clarify is that we can find shareholders' equity at the end of period in another way. Right now, we have calculated shareholders' equity at the end of period by subtracting total liabilities from total assets, because by definition, shareholders' equity is the residual claim on the company. Whatever is left after paying all the liabilities is for equity holders. However, we can find shareholders' equity in another way. Let's consider this. We consider the amount of shareholders' equity in the beginning of the period, right? Then the amount of net profit after tax, so the amount of profit of the company from its operations, is all for equity holders. So we should add net profit after tax to the shareholders' equity. So as a result of positive net profit after tax, the value of shareholders' equity increases in a company. However, whenever a company pays dividend to its shareholders, the shareholders' equity in the company decreases by that amount, because in that way company is paying out a cash flow to its shareholders. So we should subtract $36 for dividend payment, and we should subtract $11 for share repurchases. In share repurchases, company buys equities holders share from them. So this is a cash outflow from the company to equity holders. So the amount of equity that shareholders have after share repurchase decreases. As you can see, this calculation gives you the same number that we had previously. Okay, this example showed us how different transactions can affect balance sheet, income statement, and cash flow statement. Thank you very much.